Now is a great time to be a real estate investor because this new tax bill just introduced some huge tax benefits that can be used to greatly reduce your taxes. The new 100% bonus depreciation rules will allow investors to take extremely large deductions against their rental properties starting in 2025. But not too many people actually understand how it works or how to use it. So whether you already own rental properties or you are considering it in the future, it will be very beneficial to understand these new changes so you can plan accordingly. So in this video, I am going to explain some of the largest tax benefits in this bill for real estate investors as a practicing CPA that works with them every day at mycpacoach.com. And if that sounds good to you, please hit the like button below, comment your thoughts as we go through this, and let's go ahead and dive in. Okay, so the largest tax benefit in this bill for real estate investors is the return of 100% bonus depreciation as of January 19th of 2025, and there are three big strategies here. First, this will allow you to write off 100% of certain improvements you make to your rental properties. So if you need to add new floors, new windows, ceiling fans, or whatever the case may be, this provision may allow you to expense that entire amount to increase the value of your property while reducing your taxes at the same exact time. For example, let's say you need to spend $20,000 on new appliances, flooring, or furniture that you need in your rental property. Well, the IRS classifies these types of purchases as 5-year property, which would usually limit your deduction to just $4,000 over a 5-year period. But with 100% bonus depreciation, you may be able to expense this entire purchase in the year that it was placed into service. So for investors that are considering purchases around their rental properties, bonus depreciation may be something that you can use to pay less taxes along the way. But the second big thing it will do is allow some investors to write off up to 40% of newly acquired properties, which may incentivize people to buy new properties to write off more of their income on their taxes. Now, this can be done by applying bonus depreciation to eligible parts of your property that qualifies for it, which is important to understand because bonus depreciation does not apply to the land your property sits on or the building itself, but it can be applied to most tangible assets located inside your properties. The problem though is that most people lump the value of those tangible assets into the value of their entire building, causing them to expense it over 27.5 or 39 years depending on the type of rental property they own. And 100% bonus depreciation only applies to tangible property that lasts less than 20 years, causing many people to miss out on expensing the value of qualifying assets located inside their rental properties. But fortunately, the tax law does allow you to separate the value of those assets from the land and building itself through the use of something called a cost segregation study. This study will segment your property into different buckets based on its IRS classification, ranging from 3-year to 39-year property, which will allow you to clearly identify and separate components in your property that are eligible for 100% expensing. So things like furniture, ceiling fans, fixtures, refrigerators, stoves, and other items that are usually individually depreciated over 5, 7, or 15 years may be fully expensed if properly identified with a cost seg study, and I'll link my go-to vendor for this in the description below. But keep in mind that 100% bonus depreciation is only for property placed in service after January 19th of 2025. Many real estate investors and high income earners will likely justify buying more rental properties before this year ends to trigger very large depreciation deductions to offset other income they report on their tax returns. And if that's you, make sure you do your research around the IRS passive activity limitation rules, which ties in to our third strategy around using these deductions to offset your income. So look, if you go and trigger these large depreciation deductions, but do not have enough eligible income to use it against, you may lose the benefits of that deduction during that tax year. For example, let's say you earn $10,000 $30,000 of rental income and trigger a $100,000 depreciation deduction. Well, now you are left with a $90,000 rental loss. And by default, the IRS classifies rental activities as passive, which cannot offset more than $3,000 of earned or ordinary income unless you meet certain criteria, which means that if you have a $90,000 rental loss, you would only be able to use $3,000 of that loss to offset your W-2 or business income, leaving you with $87,000 in losses that you cannot use that year and would therefore have to carry forward. But fortunately, there are several loopholes and strategies to get around these limitations. You or your CPA just needs to know about them and select the right one given your situation. There's the real estate professional tax status, the short-term rental loophole, the business use loophole, and certain business structures which may allow you to use those rental losses against other active income that you may earn. Now, I have a separate video that explains these loopholes in great detail, so make sure you subscribe and check that out. But also, please keep in mind that even if you do qualify to use those strategies, the decision to use bonus depreciation should also weigh several factors like your income, your tax bracket, and how your income is being classified. Because if you are already in a very low tax bracket, it may not be very beneficial for you to trigger these large amounts of depreciation deductions. For example, someone in a 37% tax bracket might save $37,000 with a $100,000 deduction, while someone in a 10% tax bracket may only save $10,000. And keep in mind that cost segregation studies are not free, right? So if you're expecting higher amounts of income in the future, you might want to save your depreciation for later so that you can trigger it when it is most beneficial for you. These are all things that should be considered in an all-encompassing tax strategy. And if your CPA is not working with you to plan around these things to reduce your taxes before the year actually ends, just apply to work with my team today at mycpacoach.com.